Hello. Welcome to DNF Tax Consultant. I'm here for you. I'm here to equip you with the necessary information you are supposed to know about taxation. As usual, don't forget to subscribe, share, and comment. Today, I'm taking you through tax incidence. Tax incidence refers to the distribution of the burden of paying taxes between buyers and sellers of goods and services. Basically, we are saying the burden of paying taxes can be transferred or can be shifted from different parties in the market. But now it depends on the types of taxes. We have direct taxes, we have indirect taxes. Under direct taxes, the burden of paying taxes cannot be shifted from one person to another. The person in which these taxes are levied affected by the incidence of paying tax, affected by the burden of paying tax. For example, there is imposition of 10% income tax. The person in which these taxes are levied must pay the full amount to the government. But under direct taxes, the burden of paying taxes can be shifted from one person to another, from suppliers to buyers, or from buyers to suppliers. For example, there is imposition of excise duty on the manufacturing of sugar. What manufacturers do is that they make sure that they include the tax component in their prices. So ultimately, the burden of paying taxes will be shifted to buyers. There's what we call the impact of tax and the incidence of tax. The impact of tax affects the one who pays tax in the first instance, but the incidence of tax or the burden of paying tax affects the one who actually bears the tax. So, in this case of sugar manufacturing, when excise duty is imposed, suppose there is imposition of 10% excise duty, manufacturers pays tax at the first instance, but when they quote their prices, they include the tax component, so consumers actually bears the tax component. So the tax incidence will affect consumers. So tax incidence does not depend on whether the government has formal obligation to collect taxes from buyers or from sellers, but it depends on the elasticity of supply and demand. Holding all other things constant, we want to consider the one variable, price. Suppose the demand is price elastic. In this case, we are saying consumers are more responsive to price changes. If there is an increase in prices, they reduce their purchasing power and they end up shifting the burden of paying taxes to the producers. But if the demand is price inelastic, in this case we are saying consumers are less responsive to price changes. If there is an increase in prices, they continue to buy, especially on basic commodities. Let's consider if the tax is taxed on suppliers, or we want to consider the supply side. If the supply is price elastic, if the industry is not paying more, suppliers will reduce their supplies. So they end up shifting the tax burden to producers. But if the supply is inelastic, if the industry is not paying more, suppliers continue to supply. So ultimately, the burden of paying taxes falls on the suppliers. So the aim of tax incidence is to make sure that there is a fair distribution of the burden of paying taxes in the economy. So the government must make sure that the persons which are paying these taxes pays at ease. So that's what we call tax incidence. Thank you for watching. Don't forget to subscribe, share, and comment. Goodbye.